If you're receiving the state pension, pension credit, or any DWP benefit right now, listen closely, because this isn't something that's coming later. It's already happening. Hey everyone, welcome back to Pension and Benefits Guide, the channel that helps you cut through the confusion and understand exactly where you stand with your money. If you're new here, consider subscribing, because today's update genuinely matters. Right now, the Department for Work and Pensions is actively reviewing accounts, sending out repayment letters, and rolling out new monitoring powers that came into force this year. And starting the 13th of August, HMRC is beginning a mass mailing of tax letters to over 1 million pensioners across the country. The people hit hardest by all of this are usually the ones who had no idea it was coming. Nobody told them what to look out for, what the deadlines are, or what their rights actually are when one of these letters lands on the doormat. So today, I'm walking you through 4 separate processes that are running at the same time right now, and what you can do while there's still time to act. Let's start with what's happening today. From the 12th of August, 2026, HMRC is sending out what are called Simple Assessment Letters, officially known as PA 302 notices, to pensioners right across the UK. These are tax bills, and they're landing because a growing number of pensioners now have total income above the personal allowance of £12,570 a year. The full new state pension currently sits at £12,547.60. That's a gap of just £22.40. So any extra income at all, savings interest, a small private pension, can push you over the threshold and trigger a tax calculation. HMRC sent out more than 1.3 million of these letters last year, and that number keeps growing as the state pension rises under the triple lock while the personal allowance stays frozen. This letter is not a scam. It's a genuine tax demand. The payment deadline is the 31st of January, 2027. Miss it, and interest starts from the 1st of February, with a 5% surcharge added after 30 days. If you think the amount is wrong, you have 60 days from the date on the letter to challenge it by calling HMRC on 0300 200 3300. If you have savings sitting outside a tax-free wrapper, moving them into a cash ISA can eliminate this problem going forward, since interest earned there is exempt from income tax. So check your letterbox from today, and if something from HMRC arrives, open it straight away. Now here's where the real impact becomes clear for a lot of people, the DWP's overpayment recovery process. New research has revealed just how tough this has become. The Public Law Project published findings this year showing that in 2023-24 alone, there were 686,756 cases of overpayment debt raised by the DWP that were identified as official error. That means it was the DWP's own mistake, not fraud, not a failure to report, but a system error on their end. And in most of those cases, the claimant is still being asked to pay the money back. 30 leading charities, including Age UK and Amnesty International, have written to the Work and Pensions Secretary asking for the law to change, so that overpayments caused by official error, ones the claimant couldn't reasonably have known about, aren't recovered from them. That campaign is still ongoing, and the law hasn't changed yet. Which means right now, if you get an overpayment letter, you're still expected to pay, even if the mistake was entirely the DWP's. But here's what almost nobody knows: you do have rights. If you receive an overpayment letter, you have 1 month from the date of the decision to request a mandatory reconsideration, a formal review asking the DWP to look at the decision again. If the overpayment happened because of a DWP error rather than anything you did, you can argue that recovery shouldn't go ahead at all. And in cases of genuine financial hardship, the DWP does have the power to write off the debt entirely, though they won't offer that themselves unless you raise it. That 1-month deadline is real, and it matters. Quick pause here: if you're finding this useful, hit like, drop a comment letting me know which of these 4 issues affects you most, and subscribe so you don't miss updates like this. It genuinely helps the channel keep making these breakdowns. Now, the third issue involves new bank monitoring powers being extended to existing pension credit and housing benefit claimants starting this month. The Public Authorities Fraud, Error, and Recovery Act 2026 received royal assent in June 2026. Under this law, banks are now required to flag accounts to the DWP where the balance appears to exceed the eligibility thresholds for means-tested benefits. For pension credit and housing benefit, that savings threshold is £16,000. From August 2026, this monitoring is being extended to existing claimants, not just new ones. So what does this mean in practice? If you receive pension credit or housing benefit, and your savings have gone above £16,000 at any point, say, from a property sale, an inheritance, or a pension withdrawal, and you didn't report that at the time, you may soon get a letter asking questions about your finances. Here's what you're required to report if you receive pension credit or housing benefit: any change to your savings or capital, moving to a new address, traveling outside Great Britain for more than 4 weeks, and any change to your income. If any of these apply to you and you haven't reported them yet, do it now, before the DWP picks it up through bank data and calculates an overpayment going back months, or even years. And finally, the fourth issue, and this one affects the largest number of people, a review process. The DWP changed significantly as of the 2nd of June, 2026. If you or someone you know receives Personal Independence Payment, PIP, this matters. Around 3.9 million people in England and Wales receive it. From June 2026, the DWP is extending the minimum gap between PIP award reviews to 3 years for most existing claimants aged 25 and over, rising to 5 years at their next review. Previously, some people were being reviewed every 9 months, even when their condition had no chance of improving. That pressure has now eased. But here's where the risk lies. The obligation to report changes works both ways. If your condition has gotten worse and you now need more support than your current award reflects, you're entitled to ask for a review. And if you don't ask, your award simply stays where it is. Nobody is going to call you up and check in. On the flip side, if your circumstances have improved and you're receiving more than your condition now warrants, you're required to report that. Failing to do so puts you straight into overpayment territory, especially now that the DWP's new bank monitoring powers are active. So if you feel your PIP award no longer reflects your actual needs, in either direction, call the DWP. And if you're not sure where you stand, Citizens Advice on 0800 144 8848 can help you work through your position before you make that call. So let's bring it all together. HMRC is sending tax letters from the 13th of August to over 1 million pensioners. If one arrives, open it, note the January 2027 deadline, and challenge it within 60 days if the figure looks wrong. The DWP is recovering overpayments, including ones caused by its own errors. If a letter arrives, request a mandatory reconsideration within 1 month, and raise hardship if it applies. New bank monitoring powers are now live for existing pension credit and housing benefit claimants. Report any unreported changes now. And PIP reviews have been restructured since June 2026. If your condition has changed either way, report it rather than waiting. None of this is simple, and honestly, it isn't meant to be easy to follow. But knowing what's actually happening is the first step to not being caught off guard by it. So tell me in the comments, which of these four changes affects you or someone in your family the most? I read every comment, and it helps me know what to cover next. If this helped clear things up, do me a favor and pass it on to someone you know who receives the state pension, pension credit, or PIP. One conversation could make a real difference before a letter shows up that they weren't expecting. Thanks for watching, and I'll see you in the next one.